So welcome everyone. We're so glad to have you here to participate in the first of our three-part webinar Lunch and Learn series on catastrophe risk management. This webinar series is sponsored by both the meteorology alumni of Penn State's Weather Risk Alumni Society, that's big, in partnership with the International Society of Catastrophe Managers, or as we like to say, the ISCM. I'm Sherry Zola. I represent the ISCM. I'm on the executive board, and I'm really glad to be here today to host the first part of this series. I'm going to welcome and introduce our presenters, Bastian and Kim Roberts of JLT Re. Before I actually go into their introductions, I'd like to let you know that really this webinar is being held because of the work that Bastian has done. It was his idea. He brought it to the ISCM, and through his efforts, we've been able to develop this series. The only reason he's not hosting today and being the main contact is because he's actually speaking. So he will likely be your host for the next two seminars that we have. So to introduce them, Brian is an assistant vice president and meteorologist for JLT Re. He focuses on catastrophe exposures and risk management. He serves by educating the JLT Re client base on catastrophe model usage and output, and developing and deploying their exposure and data analytics platform, Catastrophe. In addition, he consults with clients in regards to specific catastrophe-related studies and exposure management projects. Brian holds a bachelor's degree in meteorology and master's degree in systems engineering, both from Penn State University. He is also the founder and president of the Penn State Weather Risk Alumni Society and a member of the International Society of Catastrophe Managers. He's an active volunteer climate and weather educator for the nonprofit NEPRIS as well. Kim Roberts is a vice president and meteorologist for JLT Re, focusing on catastrophe modeling, research, and risk management analytics. Kim began her career in academia, developing algorithms designed to predict hurricane wind structure from infrared satellite data, then transitioned to the field of catastrophe risk modeling, with a special focus on hurricane and storm surge modeling. Over the course of her career, Kim has led the development of sophisticated computer models to predict hazard and potential losses from catastrophic weather events, as well as developed analytical solutions for the reinsurance market to increase profitability, reduce exposure to risk, and help develop economic efficiency. Her current role is not only in client services and analytics, but also in research and development, most notably as the lead developer of proprietary wind risk models. So Brian and Kim are going to present today, and when they are done, we are going to have a question and answer session. So during the presentation, you all have a Q&A button somewhere on your screen, and it's different based on the browser or the type of computer you're using, but you should be able to access and send in a question if you're interested. We're going to track those questions, and at the end of the presentation, we're going to try to visit as many of them as we can. And unfortunately, if we can't get to all of them, we will make sure to respond via email to the group who participated once we have the webinar done, if we haven't been able to cover everything. So with that, I will leave it to Brian to take it away. Thank you.
Yeah, thank you, Sherry. And yeah, good afternoon, everyone, or morning, I guess, if you're Pacific time. It is an absolute pleasure to be a presenter for the first of this three-part webinar series on catastrophe risk management, something that's near and dear to my heart. And as Sherry mentioned, the idea was sort of born out of wanting to, especially on the meteorology side, expose more and more meteorologists, both alums at Penn State and students, and we've opened this up, obviously, to the ISCM as well, to give everyone a better understanding of what exactly is catastrophe risk management, how are catastrophe models used, and what is really the role of the catastrophe risk manager. So before Kim and I dive into the presentation, I do want to note that we do have a varied audience. I mentioned both Penn State meteorologists, but also we have faculty and students at Penn State and the ISCM members. So given the varied audience, we're going to do our best to accommodate everyone with the material. However, the presentation, especially as part of the broader series, is going to focus particularly on those new to catastrophe risk management. So just keep that in mind. If you're an experienced professional and you just want to listen while you enjoy your lunch, that's fine too. But we have what we think is some pretty exciting introductory material for catastrophe risk management, and I'm happy to be the one to kick things off today. So without further ado, we'll dive right into the objectives. Kim and I are going to be dividing and conquering. The goal here is to hit on the 7 items you see here on the screen. So we're going to start by providing an overview of natural catastrophe risk, covering a few key definitions and discussing where both globally and domestically insurance and reinsurance companies need to manage their exposure to catastrophic perils. Then we're going to walk through just a few of the motivations for managing catastrophe risk, including some of the regulatory requirements and input from ratings agencies. And all this ultimately rolls up to meet one simple requirement, and that's pay losses and fulfill the promise to the insured. And there'll be more on that to come. From there, I'm going to hand it off to Kim, and she's going to describe the role of the catastrophe risk manager as well as walk through the broader risk management process. Kim's going to highlight a couple forms of risk management, including financial risk transfer, and then also provide an overview of some common risk financing techniques. And so following the discussion of risk financing, we'll discuss some of the common tools that are used for managing catastrophe risk. That includes catastrophe models. And to close things out, we'll be providing an overview of the motivations for using catastrophe models and highlight what the models are and sometimes more importantly, what they are not. So yeah, we encourage everyone listening to ask questions via the Zoom application, as Sherry mentioned. There'll be that Q&A session at the end. So if you do have any questions, please submit them, and we'll make sure to hit on those when we get to the end. So again, without further ado, let's dive into things. So start off with the fundamentals, just a few definitions. Now, while there are other man-made catastrophes such as cyber, terrorism, mass tort, the focus of today is really going to be on natural catastrophes. By definition, a natural catastrophe is simply an extreme natural event causing widespread and usually sudden damage and suffering. The easiest thing to think about here are meteorological or geological events such as earthquakes, hurricanes, tornadoes, hail, tsunamis, and wildfires. You get the gist. Now, while it might seem silly to define a natural catastrophe in the context of the insurance industry and coverage of loss due to these events, the definition of what exactly is a natural catastrophe is non-trivial. So properly defining these events is critical in the insurance industry, ultimately for the purposes of defining the coverage and then effectively and profitably underwriting for the potential loss. Now, the insurance industry in the United States as a whole also defines an event that is catastrophic. An example of this is Property Claim Service, or PCS. PCS defines a catastrophe for the insurance industry as one that causes more than $25 million in direct insured loss to property and affects a significant number of property holders. Now, the PCS investigates loss events to determine whether the damage meets the threshold necessary. Once it determines that an event is a catastrophe, they assign a serial number that is recognized throughout the insurance industry. Now, with that number, insurers track losses and reserves related to a single discrete event. In addition, many reinsurance contracts use these PCS serial numbers to determine which losses will actually trigger the reinsurance coverage. So as you can see, it's pretty important that we understand and effectively define exactly what the natural catastrophe is because it has so many financial impacts. Now, I know I hit on a few of these already in my little brief monologue on the previous slide, but because we're going to be using this terminology frequently throughout the Lunch and Learn series, so not just today, but also next month and in December, we thought it'd be important to put some of these common definitions out there in the open just so you can see. And we're going to have all the slides available to everyone at the end as a takeaway that they can use as a reference. Now, the first is peril. Now, peril is simply the cause of loss. So natural perils, as I mentioned before, they'll include earthquakes and windstorms. And these causes of loss are usually specifically noted in the covered section of an insurance or reinsurance contract. So that's a peril. Now, the second is hazard. A hazard is referring to the danger associated with the peril. So in the case of a windstorm or hurricane, the primary hazard would be wind. Now, other hazards, however, could include storm surge. So that's just another example of an additional hazard associated with the peril hurricane. And then finally, we have risk. Now, I did this. If you Google search the term risk, you're going to stumble across all sorts of definitions. At least I did. And for the purposes of today's discussion, and over the next 2 in our series, risk will actually have 2 different meanings. Now, the first meaning is a common one and typically applies in all contexts. Risk is the uncertainty leading to a potential adverse outcome. So in the context of catastrophe risk management, that uncertainty can be associated with the vulnerability of the exposures to the peril, so the buildings themselves, such as the building's construction or the occupancy. But there's also inherent uncertainty of the hazard associated with the peril. We'll get into that in a little bit. The second definition of risk is simply a shorthand word to describe an object insured against these various perils. So in the insurance and reinsurance industry, this is pretty common, and catastrophe risk managers often refer to the physical automobile or the building or whatever the structure is as a risk. So two different definitions, the first one being sort of a more common definition for risk, but the second is actually a noun, or I shouldn't say a noun, it's an objective noun. So we're referring to the thing that is being insured. Now, Kim is going to be discussing the process of catastrophe risk management, so I won't go through that final bullet there in too much detail, but I have provided a simplified definition for you as a reference. So more on this to come. So where do we find catastrophe risk? Globally, as you can see by the image here, catastrophic perils can be found on every inhabited continent. So in South America, the major perils would include riverine and flash flooding, as well as earthquakes and landslides. In Europe, perils include winter storms, heat waves, hailstorms, and flooding. In Asia, catastrophes include earthquakes, typhoons, and tsunamis. And finally, in North America, we really do see the gamut. So everything from floods to winter storms to hurricanes, earthquakes, severe thunderstorms, and wildfires, we just about have it all here in the U.S. Now, just this year, so kind of pretty amazing, just this year alone, we've had 4 landfalling hurricanes, including Harvey, Irma, Maria, and Nate. And through June of this year, 6 large-scale thunderstorms caused nearly $18.5 billion in loss. Now, the wildfires in California alone this year have burned more than 850,000 acres. And just the wildfires that we've had this month, so in the month of October, of the 850,000, 170,000, just from the handful this month, destroyed an estimated 3,500 structures. Now you can see the image here. This is a county-level risk metric that was generated by JLT Re, and I found this on CNN Money. Now, while I've had a hard time trying to find the raw data, because I'm really curious about the raw data that they use to develop the map, I think it does a fairly good job of visualizing the relative risk differences to natural perils across the U.S. In general, we find that in the central and southeastern part of the U.S., we find that they have the highest risk due to those higher frequency perils such as severe thunderstorms. Now, with that said, you can also see that no matter where you live in the U.S., there's some risk of a natural catastrophe or natural peril. So we do care about managing catastrophe risk here in the U.S. Now, what are some other motivations? The motivations for managing catastrophe risk, I think I alluded to this earlier, ultimately stem from one key insurance and reinsurance philosophy and concept, and that's this idea of indemnification. So to indemnify, for those unfamiliar, it really just means to compensate someone for harm or loss. So if we think about that term in the context of insurance, it's really the promise to indemnify or compensate the insured, the person who purchased the insurance or reinsurance, in the case of a covered loss. This promise is so important. It's actually sacred in our industry. So the promise, and then ultimately the experience that the insureds have, ultimately when they're submitting a claim due to a loss, I mean, they're submitting a claim on that promise. And it's really the insurers and reinsurers that are constantly working to strengthen and improve on being able to deliver on that promise. Now, additionally, in the United States, we have a state-regulated insurance industry with regulators and rating agencies in the mix to monitor market participants to ensure they have the financial position to withstand outsized losses and ultimately pay claims. We want to make sure that insurance companies and reinsurers are ultimately able to pay those claims. So the regulators and ratings agencies work to provide guidance as well as stress test the insurance companies to make sure, again, that they can fulfill those promises. And one of those ratings agencies is AM Best. So I put some of the information that they have on their website here up on the slide. Now, I'm going to apologize in advance for this slide. I did not make it pretty like I did the other one, so I'm not going to dive through every single bullet here. What I'd encourage you to focus on are those numbers, 1, 2, and 3. AM Best, as a ratings agency, is in the business of evaluating insurance companies to ensure they maintain a certain amount of money also referred to as capital. They want to make sure they have a certain amount of money in the bank to be able to meet that financial obligation. Now, in the context of catastrophe modeling and catastrophe risk management, AM Best will evaluate and rate an insurance company based on their risk of insolvency, risk of inadequate pricing, and risk of failure of key processes or controls. Now, AM Best has refined this approach for evaluating companies over time, but today what's referred to as their BCAR, or Best Capital Adequacy Ratio, it does include, and I've circled it there for you on the slide, it includes a component for catastrophe risk. So catastrophe risk is important, and ratings agencies look at this, and it's a major part of the motivation, ultimately, in addition to the promise that the insurers and reinsurers are making. It's a big part of that, big part of their formula, managing catastrophe risk. Now, one of our goals today in discussing catastrophe risk management is to highlight the specific role of the catastrophe risk manager and give a taste of how the models are used as part of that individual's responsibility. So to tee things up, I'll first mention that in general, insurers and reinsurers have moved from this more empirical, experience-based culture of pricing, so using raw, like historical data, to one that's much more statistically based and much more quantitative. So because of this, the role of the catastrophe risk manager has grown to include many different activities, including underwriting decision support, exposure data accumulation and management. That's a big part of my role at JLT. Post-event loss estimation, claims analysis, and catastrophe model adjustment. Catastrophe risk managers also support and advise on strategic growth planning and reinsurance purchasing. And finally, the catastrophe risk manager is responsible for selecting, running, validating, and tuning those catastrophe models. So all of these various responsibilities and many of the risk management techniques implemented by the catastrophe risk manager in the organization are structured around those requirements defined by the market regulators, as we mentioned. And although there is a quantitative basis to catastrophe risk management, there's still also a significant amount of uncertainty that needs to be managed and appropriately accounted for in the decision-making process. So at this point, I'm going to hand it off to Kim, and Kim's going to be first walking through the risk management process as part of managing catastrophe risk. So Kim, I'll let you take it from here.
Thanks, Brian. That's a great introduction to some of the fundamental terms and principles, and I'm going to kind of focus on the overall cat risk management process, some of the strategies we employ, and some of the tools that we use to help manage catastrophe risk. So an insurance company basically has their entire value tied up in the risks that they insure. So an insurance company collects premiums on those risks, but that premium base is typically not large enough to cover the potential loss or payout that would result from a major catastrophe. Therefore, it's imperative to the financial health of an insurance company to develop and implement a risk management strategy. This enables them to be able to follow through on their promises to their insurers in the event of a catastrophe, and also to remain solvent as a company. So you'll hear the term exposures used often. This essentially means the value of the risks that you are insuring. So if you are highly exposed in a certain area, it means that the risks that you insured are valued highly in those areas. And what that also means is that if a catastrophe were to occur, your company needs to be adequately prepared financially to absorb the cost of those properties requiring repair or requiring replacement. And again, the premium base that you've collected is typically not enough to do so. So the first step in this kind of process is to identify where your exposures are physically located, how much value is in those risks. And honestly, you'd be surprised at how many insurance companies generally don't have a firm concept or grasp of where they're most highly exposed. That's one of our jobs at JLT Re, is to really help inform our clients of where their exposures are and how much value is tied up in those exposures. And are there any areas where you have a very high concentration of exposures, meaning that if a catastrophe occurred, would the loss be disproportionately large? So the next step is to determine, once you know where they are, the next step is to determine whether they're at risk from natural catastrophes. Are they located near a fault, for example? Are they located on the open coastline where storm surge could be an issue during a landfalling hurricane? Do winter storms frequently impact the power grid in that area? These are just very simple and few examples, but for some insurance companies that have risks spread across the continent or even across the globe, it's really important to understand where they are and what they're at, what perils they're at risk from. So we will go into more detail on subsequent slides about some of the tools that are available. Some of these include exposure management tools, computer models, catastrophe models, or even hiring a reinsurance intermediary to help you with your risk transfer strategy. So some of these can be very expensive. So the risk management team at a company has to determine the costs and benefits of each option, and then they would move forward with implementing, monitoring, and constantly revising those strategies as their book evolves. So one of the main modes for managing risk is what's known as the risk transfer mechanism. One of the most common risk transfer mechanisms is to purchase reinsurance. This is basically just insurance for insurance companies. It's not as simple as going out, shopping rates for a single policy, and then buying one from one specific insurance company. It's very complex, and there are many different types of reinsurance, and I'll kind of go into those on the future slides. Insurance companies can also purchase lines of credit, working with banks or financial institutions that can help them pay out in the event of a catastrophe. The last two bullet points on this slide are sort of emerging forms of risk transfer mechanisms that are becoming more common in our current marketplace. One of these is a catastrophe bond. It's also known as a cat bond. These are risk-linked securities that transfer a specified set of risks from an insurance company to a set of investors. So these were created, I guess, first in the mid-1990s in the aftermath of some major catastrophes like Hurricane Andrew and the Northridge earthquake. And these are essentially worded in such a way that they will pay out only if a certain parameter is met. For instance, a central pressure in a hurricane within a certain region, or a certain intensity of shaking in the case of an earthquake in a certain region. If that criteria is met, then the catastrophe bond will pay out to the insurance companies that have developed the cat bond. So this is sort of a form of transferring risk to investors rather than transferring risk to a reinsurance company. There's also industry loss warranties that are, again, non-traditional but becoming more common, and these are a form of reinsurance through which an insurer can gain coverage based on the total insured loss experience by the industry rather than what their own losses are from a specific event. So these are some examples of risk transfer mechanisms. The next slide is going to go into more specifics on reinsurance, which is one of the most common and remains one of the most common forms of risk transfer in the insurance marketplace. So in its simplest form, reinsurance is insurance for insurance companies. It's complex. It's a layered policy typically with sometimes 20 to 30 different reinsurance companies participating on a single program for a single insurance company. Reinsurance can cover many risks or just one risk. Pictured on this slide to the left are some of the primary insurance companies that many of you may have policies with that you hear about commonly. Examples are Allstate or Liberty Mutual or Geico, some of the major players in the insurance market. On the right-hand side are the reinsurance companies that are likely participating in many of the reinsurance programs for the primary insurers that you see on the left-hand side. So there's, simply put, two basic kinds of reinsurance policies, one of which is a facultative reinsurance. So this is reinsurance that is for an individual risk. Typically, this risk may be a large or unique risk that would be otherwise uninsurable. So this would be designed specifically to protect a single risk in your book. Or you can use or develop something that's called treaty reinsurance. So treaty protects an entire portfolio of risks. So this could be across different lines of business, across different geographies. It's lumping together all of your risks into one and applying a blanket reinsurance policy across all of those risks. And on the next slide, we'll go into it in a little bit more detail. Within both facultative and treaty reinsurance, there are certain subsets of policy structure. So in this case, XL stands for excess of loss. This typically means that the reinsurance policy will pay out above a certain threshold. So you could think of this almost like a deductible. but is instead called a retention in reinsurance. So the insurance company would absorb all of the losses that occur below that retention or deductible level, and then the reinsurance policy would come in and pay out all the losses above that retention level. If you have a treaty policy, meaning it covers multiple risks, the retention can be applied on a per risk basis, or more commonly, it's a retention that covers the entire portfolio together, and that's pretty much the most common form of reinsurance. It's a treaty excess of loss policy is very common in the industry. Some policies are also structured in such a way that no matter what level of loss, the insurance company will share a certain percentage of the loss with the reinsurance company. So an insurance company might retain 30% of all loss, and the reinsurance company would retain the other 70%, for instance, and that's called a proportional reinsurance policy. Sometimes this is structured on a quota share basis, meaning that reinsurer also takes part of the premium, not just takes on the loss if it should occur, but is also able to collect on the premiums, and that's another type that's called a quota share. So I realize this is a lot of information. On the next slide, I'll kind of try to put it into a visual reference for the most common form of reinsurance, which I mentioned is a treaty excess of loss structure. So hopefully that can kind of help solidify some of these complex structures. The series of boxes on the left is a schematic that's meant to represent the complex structure of a treaty reinsurance policy. So starting at the bottom, it's the zero loss level. And then as you rise within the boxes, it's representing an increasing loss experience. So each of these boxes might represent different layers of protection with different costs to the insurer associated with them. So essentially, an insurance company will pay premiums on those layers with the expectation that the reinsurer will cover any loss that's occurred within that layer. These structures are often so complex that an insurance company will hire a reinsurance broker to help them structure this policy and then go out into the reinsurance marketplace to gain participation in the program. So the broker goes out, speaks to reinsurance companies in the marketplace, brokers these deals, and sets up the cost structure associated with each of these layers. And as I mentioned, often there could be 20 reinsurance companies participating on one insurance company's program, and often these policies are worth tens or even hundreds of millions of dollars. Each year, these contracts have to be restructured and renegotiated based on whether an insurance company is growing into, for instance, certain catastrophe-prone areas, or whether they've sustained significant losses over the years. So if they actually have to make a claim to their reinsurance program, that affects the prices that they will ultimately pay the following year. But the whole goal here is to provide financial stability to the insurance company, which directly translates into the ability to follow through on their financial obligations to their policyholder, which is the ultimate goal of insurance altogether. Okay. So what are some of the tools that are most commonly used? We've talked about risk transfer and a little bit about catastrophe modeling, but there's other tools as well that we have that enable us to become efficient risk managers. So it's a complicated process. As companies grow geographically, they can often insure risks that are exposed to many different types of natural catastrophes all across the globe. And over the past few decades, as computer technologies have become more readily accessible, risk managers have been developing various tools and software to help manage this risk. And this can include everything from complex databases that allow you to sort through and store policy information, and tools that build off of databases that can analyze the policies and kind of perform checks and balances on accumulations of exposures, for instance, in risk-prone areas. And then all of this increasingly is done within a GIS framework. So this really allows for effective visualization, and the spatial analysis tools that come along with GIS software are really useful in our industry to help us understand these accumulations and where our book is most vulnerable. And all of these insights gained based on your existing portfolio and these tools that we can use can then inform the decisions that we make about underwriting certain future policies. So they go into our underwriting decision support tools, and furthermore, they can help inform the development of risk capital models. So risk capital models are increasingly becoming a core part of many insurers' risk and capital management processes. They promote effective use of capital, and oftentimes they can present alternative strategies to senior management for effectively managing risk through the use of these types of models. So I'm going to, I think, pass it back to Brian at this type to go into why we use catastrophe models. So I'll hand it back to you, Brian.
Great. Yep. Thank you, Kim. So in addition to those common tools that Kim walked through very nicely, catastrophe models, and that's the highlight. That's the topic of our next, the next part, the second part of this series. So it's an important one. And catastrophe models represent probably the most common tool used, we'll call it, in the catastrophe risk manager's tool belt. And so to help understand why catastrophe models are used, let's revisit just very quickly here the difference between a typical good, we'll say, and an insurance policy. So you can see on the graphic here, for most non-insurance products, the cost of the product is typically well defined, and it's known at the point of sale. That allows us to actually price that product so that we can ultimately make a profit. That's the end goal of a business, right? Now, in the insurance and reinsurance industries, they represent some of the few businesses where the price for the product, that insurance or reinsurance policy, the price of that is typically set without any knowledge of ultimately what the final cost is going to be. So if you remember, think about an insurance policy that you might have, or your parents have, or your dad, or your uncle, or your dog. The premium that you're paying, ultimately that the insurer or reinsurer receives at the inception of the policy. So your policy starts, you're paying that premium to get the contract in place. That's ultimately collected with that promise to pay, as we discussed, for any losses that incur during the policy period. Now, traditionally, when pricing a policy or a catastrophe reinsurance treaty, insurers and reinsurers respectively would use actuaries to actually analyze historical loss data to determine the premium that should be charged in order to remain profitable. Now, catastrophes, however, catastrophe reinsurance presents then some inherent challenges, especially for using experiential data for pricing. Now, the biggest challenge is that catastrophic events are inherently rare, and we simply don't have enough historical data to use this actuarial method by itself. Additionally, some lines of business can take many years to surface or settle in terms of claims, and a single event can cause a loss to multiple locations at the same time. So it's for this reason that catastrophe models are used. Now, while the models aren't perfect, they do help aid in filling that gap of historical loss data we have for catastrophic events, and can help provide an estimate of future loss potential. Now, policy and treaty pricing, they don't represent the only use for catastrophe models. It's an important one, pricing, but catastrophe models have a variety of other uses. In addition to pricing, catastrophe models, in addition to pricing, catastrophe models can be used for exposure accumulation management and defining geographical regions or zones where aggregation of exposure could generate an outsized level of risk or loss. That's something that Kim, I know, mentioned as being a big part of GIS tools. So the catastrophe models have that capability as well. Models can help in the process of loss accumulation. So where the model loss estimates for individual risks and portfolios are combined, they can produce a more a broader modeled loss estimate for the entire organization that can be quite useful. Catastrophe models are also used for deterministic scenario modeling and can evaluate the potential losses due to a predefined realistic disaster scenario. And finally, catastrophe models can be used in underwriting and risk management, capacity allocation and monitoring, and portfolio management and optimization. Now, the finer details of other uses of catastrophe models will be discussed in the final part of our Lunch and Learn series, so that's going to be in December. We encourage everyone to attend that session if they can, because catastrophe models have a broad range of uses. So hopefully we're able to highlight that here. So now, our preliminary discussion around catastrophe models wouldn't be complete without also talking about what these models are and honestly, more importantly, sometimes what they are not. So, Kim, I'm going to hand it back to you, and you can talk a little bit about that.
You bet. When I first joined this industry, I was a little bit confused about what a catastrophe model is, because it often gets confused with a weather forecast, for instance, or even an earthquake forecast or a tsunami forecast. And really, catastrophe models are not predictive. They do not tell us what the weather is going to be like next week. That's not the purpose of them. Often, CAT models do employ sophisticated computer models to develop, for instance, a wind footprint for a hurricane. They rely on physical models to generate single event footprints, but that's not the ultimate goal. What happens then is statistics are applied to develop a view on the frequency and the severity of loss that could occur at a given location as a result of a weather event or an earthquake event or something of that nature. They are not meant to represent a single event that's going to happen tomorrow. They're meant to be simulations of what a potential tomorrow could look like, and mainly they're based on data from the past. So they make use of complex statistics, and really they're all different, which is why a lot of CAT modeling, or insurance companies, use multiple vendor catastrophe models. It's because they all are formulated in different ways. They use different physical models to generate their hazards. They make different assumptions about how they're going to go from a hazard estimate, say a certain wind speed, to percentage damage to a building. Each CAT modeling company has its own view of how damageable a certain type of building is, and those assumptions are built into their catastrophe models. And then they really are becoming a lot more flexible. So they're allowing for different user-defined views of risk. For instance, especially with hurricanes, a lot of the modeling firms are saying, okay, we don't want to look at the past as being exactly what the future looks like. Now let's build in this idea of a warm or a cool phase in the Atlantic Ocean, and how does that affect landfalling rates of hurricanes? So you can kind of build that into your own personal view of risk, depending on what you feel the state of the ocean is, for instance, in the case of hurricane modeling. So they're highly flexible, and they're really meant to generate a view of frequency and severity of catastrophic event, not single event footprints, for example. So I'm going to hand it back to Sherry. Hopefully Brian and I have given you a good overview of the basic tenets of risk management strategy, all the way from risk transfer mechanisms through to CAT models. And as we mentioned, there's going to be additional webinars in the series, and I'm going to hand it back to Sherry to talk you through what the next steps are.
Hello. Okay, so far we've only submitted 2 questions. We're going to talk about those 2 questions, and hopefully if there are more questions, everybody will start submitting them. So our first for you, Kim and Brian, is how can we adapt past data to new climate models that claim more frequent and more intense catastrophes?
Brian, if you want, I can take that.
Yeah, go for it.
So really, most of the CAT modeling firms rely on the past. That's kind of a basic hallmark of what catastrophe models do. As I just mentioned in the previous slide, some modeling firms are starting to look at warm and cool phases of the Atlantic, for instance, to try to sort of modulate that idea that the future may not look exactly like the past. But really, it's the role of the catastrophe risk manager to look at that on a consultative basis. I know in my job, I often have to go to our clients, which are insurance companies, and say to them, this is the view of the catastrophe model, which is relying on the past, but here is how I expect things to look in the future. This is JLT Re's view of risk. It's taking a while for the CAT modeling firms to sort of adapt to this new framework of potential climate change, warming climate, and kind of what implications that has for future catastrophic perils. And it's really still in the phase of being very consultative on an individual portfolio basis, an individual insurance company basis.
Okay, great, thank you. Before I actually get to the next technical question, a number of people have asked if the slides are going to be made available. Just so you know, yes, we do plan on making the slides available to the ISCM community. We are going to post the presentations as well as, if we can, a recording of this webinar, which we're doing, on the ISCM website. And I think, Brian, you have a way you were going to share that with the Penn State folks. Can you talk to that?
Sure. So we'll make sure that all the slides are available on our website. That's psuwsriskalumni.org. And I should be able to get a list of everyone who's attended today as well, and I think I might do just an email blast that directs everybody to where they can find those slides so they can download them. And as Sherry mentioned, we're also planning to have make the recording of today's webinar available both, it sounds like, on the ISCM website and also on the Penn State Weather Risk Alumni website. So we'll make sure we have all of those materials available to everyone.
Great. Next question. How much risk or premium does an insurer typically transfer to a reinsurer, and how is this determined?
Brian, I can take this one as well. I'll leave
sure.
the rest for you.
Yeah. Good.
So, the process of determining premiums is pretty complicated, and again, it's a lot of reason why an insurance company would choose to hire a reinsurance intermediary. But oftentimes, as I showed you in that schematic where we had the kind of building blocks, an insurance company will retain a certain portion of a loss. For instance, in that example, it was $5 million. Then there will be a layer on top of that, for instance, $5 million to $20 million. And the premiums on that lower layer that have the greatest chance of a claim being made to them, those are the kind of higher frequency, lower severity events that would occur more often, so more claims could hit that lower layer. Those are going to have higher premiums than, say, the layer above it that might 20 to 50 million that might only get hit every 10 to 15 years. So they're not going to, the reinsurance company is not going to charge you as high of a premium, for instance, for that layer. And those exact prices is called rate on line. It's a percentage of the level of protection that they're giving you are determined by your loss experience, by the marketplace conditions, how many CATs have occurred in the last couple of years, is the market soft, is the market hard. There's a lot of different components that go into it based on your individual portfolio all the way up to how the market's performing itself. But generally, the lower layers you're going to pay more money for than kind of the higher loss layers.
Great, thank you. Next question. How important are policy locations to CAT models?
I can take this one, Kim. So we had a good discussion. I think it was one of the last few slides that Kim had in the bulk of her section, talking about the use of GIS, the use of exposure management tools as a means to ultimately manage where your exposures are and that accumulation of exposure. And so in terms of how important the locations are, the policy locations for the CAT models, they're critical. So without going into a ton of detail into catastrophe modeling, and I do encourage whoever asked that question, make sure you attend our next one. So Wednesday, November 8th at noon Eastern Time. Mark Bove, who's from Munich Re, who's going to be giving that presentation, he's going to be talking about the building blocks of catastrophe models, where he'll be discussing a little bit on the importance of the location in terms of generating an accurate model loss result. But the short answer here is it's extremely important. And it's something that, to be honest, the larger and larger the portfolio, the poorer and poorer we find that data quality to be. In an ideal world, we want to have the policy's location as accurate or as granular as the center, the exact central part of the building or the parcel of land. And we typically don't always get that. And the reason for the catastrophe model, why that's so important, is because their footprints that they generate for, let's say, hazards. So in the case of a windstorm model, hurricane model, understanding where that location is critical, because those thresholds of the wind field, the central pressure, if flooding may or may not be an issue due to like storm surge, the sensitivity of the losses that as a result of those footprints, it's highly subject to where that location is. And so again, for the purposes of generating an accurate model loss result, that policy location is critical.
Great, thank you. And just to add one thing Brian just mentioned about the next
Sure.
webinar, when Mark's going to talk about the building blocks of models, just to let you know that's also going to include basically the financial impact of the models on the insured, the insurer, and the reinsurer, all the different players, all the different financial players in the market. We'll also talk about the output of the models as well as limitations of modeling. So definitely encourage you all to attend the next one as well. And the final one, well, we can talk about that at the end of the questions. We'll continue with the questions first. Where is the greatest area for job growth for atmospheric scientists in the industry? What trends in jobs are you seeing?
Ooh. Kim, you want me to do that one, or you want to take this one?
I can just really quickly say that I think our industry is really hungry for people who understand the weather and the climate specifically. And I find that when I go out and talk to my clients, their ears are listening very closely when we talk about meteorology and the weather. And I think that that room for really for people who have this background in atmospheric science or in meteorology, it's just a great opportunity to kind of make a segue into this business world and bring that knowledge with it. And I think our industry is really picking up its pace when it comes to using the meteorologists that we have in our community and really respecting and listening to kind of what we have to say, to our voice in this industry. So I think opportunities are growing across the board, from working for an individual insurance company all the way up to looking to working at the reinsurance level as well. So.
Yeah, it's great. I'd say, to that question, I'd also say, atmospheric scientists, if you've graduated with a bachelor's or master's, or if you have a PhD in atmospheric sciences, you inherently have a skill set that I think many insurers and reinsurers and reinsurance intermediaries are looking for, and that's having very good analytical skills. I know for me personally, I didn't come out of school, for example, with much knowledge of the risk management space, either insurance or reinsurance. But what I have found is that, as Kim mentioned, obviously knowing the weather and knowing the climate systems is very useful for catastrophe risk management for sure. And we do a lot of different projects related to event response and claims analysis, where knowing where to find meteorological data and doing those kinds of analyses are important. But at the same time, I feel like I had an edge coming out, and I felt like there were lots of opportunities simply because of my ability to pick up some of the more analytical work that was being thrown at me. So I would say it kind of goes both ways. I'd say specifically, as Kim mentioned, having this sort of background, this fundamental knowledge of the weather and climate systems is super valuable. And at least as working for intermediaries, Kim and I, it's something that, it's a great icebreaker too. So what's the weather like? We can talk about it, but also, having more analytical skill sets is very useful for both of us as well. So I'd say the opportunities from that perspective are almost endless. And I think, Kim, between you and me, we probably know meteorologists in every part of the sector, let's call it, from underwriting to reinsurance to claims to risk management. Risk management.
Yep.
Very good. Okay, I'm going to share the next question, and I'm actually going to take a stab at this first and then see if you guys have anything to answer. So
Sure.
One question is, how do CAT managers work with underwriters, and are there issues with getting the CAT information to underwriters? In most companies, it's very important to have processes in place between the CAT modelers and the underwriting community. In some companies, it's actually the underwriters doing their own CAT modeling. So I do know at my place of work and in many others, there are inherent processes that are built in. Sometimes it's automated, sometimes it's not, and it's just done via email. But CAT modelers do their work and share the results with underwriters. There's also a lot of communication between them so that the underwriters actually understand the results coming out of the CAT models, what assumptions were made, what decisions were made, if there had to be some, because not everything is straightforward. So there's a lot of work that gets done in the CAT modeling side that's important for the underwriter to understand, for them to actually use this information and have it be valuable. So there's a lot of communication, but there's also definitely set processes built into company systems to have that information flow happen. Do you guys want to add to that?
Yeah, I guess my only addition, Sherry, I think you nailed it. I think from what Kim and I have seen from a reinsurance intermediary's perspective, where we're, at least at JLT, we tend to work with smaller companies who may not be as sophisticated technologically. We're seeing more and more a trend towards trying to adopt better technologies for getting that CAT information at the point of sale for the underwriter. And so they're using tools to try to funnel that information down, get it directly from the models itself. Maybe it goes through a process where it's augmented a little bit. Maybe there are certain underwriting guidelines that the company has in place where they can use the technology and the data from the models to inform that underwriter almost in real time as they're underwriting the policy. And this is most common, I'd probably say, for we'll call it the more commoditized risks. So your typical homeowner's policy or your auto policy or a business owner's policy, those where part of the game for the insurance company is being able to provide a quick, accurate, and solidified quote as soon as possible so they can win that business. And more companies are trying to get better about understanding sort of the CAT risk or how much of that premium should be loaded for the potential loss due to a catastrophic event, and they want that information right at the point of sale.
Great. Absolutely. Missed that. Next question.
Good teamwork.
I have such a reinsurance perspective that I'm forgetting about the primary insurance and point of sale, so
right.
That was perfect. With a relatively heavy CAT year, will alternate capital, lines of credit, be leaving the marketplace or hanging around?
I can, yeah, go ahead. You go first, Kim, and then maybe you'll answer what I was thinking.
I'm the first to admit I'm probably not the world's leading expert on alternative capital, but I do know from our meetings this fall, kind of in the aftermath of some of these events, is that even though it was a somewhat CAT-heavy year in the U.S. in general, the expectation is not that this is going to affect the reinsurance industry greatly. So I don't see a huge shift in alternative capital occurring. I think that traditional forms of reinsurance as well as these alternative forms are going to continue to be active in the marketplace, and I don't see a huge shift in that going into the next year, no.
Yeah, I would tend to agree with Kim. There's some interesting data out there. I'll highlight catastrophe bonds as being a pretty significant and growing area where alternative capital from investors has been flowing in over the past 5 to 10 years. And I think if you look back at some of the major hurricane events, even as recent as, let's say, Hurricane Katrina, you actually saw that post-event. There was an uptick in money, essentially capital, coming in to basically buy back their positions for those bonds and even creating new ones. It's kind of this interesting whatever, psychological or philosophical, whatever you want to call it, thing that happens where we figure after an event has occurred, especially a major event, the odds of having another one are likely to be less. That's at least the thought, even though we probably know that not to be true. And so we find that, no, there isn't a decrease, and in fact, sometimes there's actually an increase in the amount of capital coming in.
Very good. I'm glad to see questions are still coming in, so that's great.
Great.
We have developed a nationwide wildfire risk model. The severe wildfires in eastern Tennessee last fall was an historic anomaly. How might you recommend we calibrate in the Southeast? For example, should a CAT model react to a catastrophic event or look to the historic baseline?
Kim, that's all you.
I work on our own proprietary wildfire risk models, and it's such a tricky peril. So first of all, CAT models are supposed to capture historic anomalies to a certain degree. So there's a lot of work being done to make sure that CAT models don't just model events that have occurred in the past, but they've modeled events that could have occurred in the past. So depending on how you kind of define that, some CAT models are supposed to capture those anomalies. But that being said, I think that wildfire is one of the trickiest perils right now because we're in a bit of a warming climate, and the whole kind of risk profile for wildfire is changing. And also, we live in a world that's rapidly growing and expanding, so the types of vegetation that were around 20 years ago are completely different now. The people living in certain areas and contributing to ignition sources are completely different now. So I think the idea of relying on historic data for wildfire is a little bit risky. I know for me, we look at it from an accumulation standpoint. We just don't want to be too highly accumulated in areas where there's a significant wildfire risk as prescribed by some sort of risk model, to try to attribute actual loss estimates from a wildfire model is a serious endeavor. And I know, for instance, RMS is developing a fully probabilistic wildfire model, so they're going to have losses, they're going to have return periods, losses, things like that within the next year, and we'll have to see how that pans out for them and what those numbers look like. But from my perspective, it's very tricky to even talk about wildfire. I don't know if that helps at all, but that's my perspective.
Okay. What makes a CAT model attractive to a reinsurer? And I'm going to actually combine this one with another question. Do you see problems due to different CAT models being used by different people within an insurance company, or the same CAT model being interpreted in different ways?
I can speak to that a little bit.
Yeah, please.
So I don't know if CAT models are necessarily attractive to a reinsurer, but I know that reinsurers are sort of required by rating agencies to, meet certain criteria that are based on the output from these catastrophe models. So there's, there's reputation of different modeling firms for different perils that are fairly widely known in the community. Certain models are relied upon more heavily than others, but there's certain rules and regulations that reinsurers have to follow, and a lot of that's based on catastrophe modeling output. So to a certain degree, they're constrained. But Brian, I'll let you give your opinion as well.
Yeah, no, all I was going to say on top of that would be, I would say there are challenges certainly when you have multiple model vendors, and we talked about the role of the catastrophe risk manager. And a big part of that role is being able to obviously manage and best understand how the model fits ultimately the experience of the organization that they're using the model for. So for the case of like a reinsurer where they have a portfolio of insurance companies with risks all over the world potentially, as Kim mentioned, there are going to be certain catastrophe models that perform better based on either their loss experience or their gut feel for the science and the methodologies used for the underlying perils that are being modeled for. And so I would say, to answer that, is it attractive? I think it's attractive, maybe in a different sense, to have different models because you never want to have all your eggs in one basket. And I think there can be tendencies to try to hone in or get fixated on one particular model, but having variety to choose from is incredibly important, especially in this space where there's just simply so much uncertainty that you would like to have as many data points as you can. And there's so many different perils and geographies that you want to make sure you have a pretty good list of models you can count on to effectively manage that risk.
And just to tie this back to Todd's question earlier about where we're growing in this field, this is one of the reasons why I think people with expertise in science are needed, because we do vet these models pretty heavily. We dig into the details of them. We run stress tests on them. We look at the science that goes into these models, and we take that to our reinsurer meetings. As an intermediary, we take that when we go meet with reinsurers that are planning to participate on a program, and we can give them sort of our own, I don't want to say expert opinion, but being that we do have the science background, we can speak a little bit more to why we might tend to trust one model or one component of a model over another one. And I think that lends credibility when you're looking at these modeled outputs as well.
And I'm going to add to that as well. One of the things that makes a model attractive to a reinsurer is how the vendors are open about what's in the model. Because as a reinsurer, what Kim was saying is we really dive into really understanding the science behind the models, and they can't just be a black box. The vendors have to be open and willing to have discussions to really help you figure out and learn what they did. And those that are more communicative in that area are more attractive to a reinsurer to use those models because they understand them. The key is really making sure you as a company have your own view and you understand the risk, and then figuring out which models best help you reflect that risk is a decision that you have to make. But it's not necessarily trusting someone else in their view. It's really, if you have the expertise internally within your company, it's deciding what model to use to really reflect your view. And the second part of the question, or the other question that I wanted to refer to, was, do we think it's a problem when different people in the same insurance company are using different models? And yeah, I definitely think that is a problem, because as a company, you have to understand your risk overall. So if you can't basically combine the different views that are being used without the company easily, that's definitely an issue. So you want to be on the same page, or at least looking at your company aggregates as a total, and whether it be, even if you're pricing or doing different types of business using different models, your overall picture, you should have some type of consistency to make sure you're looking at a combined view. Anything I just said that you want to add to, Kim or Brian?
No, I think
great.
Okay.
Great.
And on the same note, there was one more question which said, out of the 5 catastrophe models mentioned in the presentation, which is the most user-friendly to learn? And I guess what I'd like to point out, and you guys can jump on it, is that, you know, computer programs these days, or software applications, or catastrophe models, they're just another application. And I think, you know, any of them, someone can learn how to actually use them to run them. The hard part, the key, is really learning really what the model's doing. So it's not necessarily how to run the model, but how the model runs. And each one of them have their own challenges, and it really takes the support from the vendors to work with to really dive in and really understand how the models actually work. And that's the key, not necessarily how to actually get them to run. I think anybody can learn how to get any of the catastrophe models to run.
Yep. Yeah, no, I'd agree with that. I'd also add, too, because this was a misconception I had. I'm not sure who the question necessarily came from. If it was a Penn State student, what I will say is that I always thought that catastrophe models were something, that you could, sort of off the shelf, no different than Microsoft Word or PowerPoint, you could just install and learn how to use beforehand. And you cannot do that. These models require pretty significant IT. You need servers and databases to actually run these models efficiently. As you can imagine, for some organizations, you may have tens of millions of locations that you're running these stochastic models against, so you need this sort of back-end IT to support all of that. And so these aren't off the shelf. And also, the catastrophe models are very, very expensive. I don't work in contracts here at JLT, and so I'm not going to throw out a number, but they aren't cheap. It's not something you're going to buy at your local, I'll just say Circuit City, because I know they're out of business.
And another question just came in, and I'll just continue with this because it's along the same lines. How will I decide what model result is right? If I use AIR and RMS model, same input data, same peril, and we'll have different exposure results, how will I decide what is right? And the answer is neither is right, and you're never going to be able to decide. Models provide input to your decision making. Neither one is the answer. You have to get comfortable with what the model is using and the science behind that model to say this is the model that we're going to use. And a lot of companies actually adjust these models to their view as well. So there is no straight answer of what is right. And if you don't have the sophistication, some companies just don't have the sophistication to dive into the models at a certain level. They may use their brokers for some of that insight, or at that point, they're using the expertise of the modeling company And if they don't like one over the other, then they might be averaging the results. So there's really no easy answer to that. It's just like Brian said, the more data points you have, the more data you have to make a decision. Like,
yeah,
you guys want to add to that?
Yeah,
okay.
Completely. There's no right answer. And
then we're gonna.
No, great.
Yeah, this is why having consultants or people within your corporation that have a background in interpreting these results or in the background science is helpful sometimes in deciding which way to lean. But having both or having multiple views of risk is important as well. So.
And there was one more question around this. How do you choose how much weight to give the different models when modeling the same risk? I think it's all the same answer.
Yep, same answer.
Yep. Yeah.
Okay.
They're good questions. We have the same ones.
Exactly. Moving on. Okay. I never knew that there's a technical definition for catastrophic with specific criteria before today's webinar. Is this definition taking into account when the NWS, for instance, uses the term catastrophic to describe the potential effects of a weather event?
I'll take this one. This is a good question. So if there's anything I've found in my early career here is that the National Weather Service, so NWS, the National Weather Service, in terms of how they define catastrophic, let's say in this case, it's not in that sense tied in at all to the insurance industry's definition. And I'll give an analogy to that actually in the same space. Oftentimes you'll see on TV, whether it's a broadcast meteorologist or on CNN, a news reporter, when they're describing, let's say, a major flood event. And I think, for example, in South Carolina, I guess it was last year, you had significant flooding and they were calling it a 1-in-1,000-year event. Well, 1-in-1,000-year event, the way they describe it, oftentimes will have a very different meaning when we think about that from a catastrophe risk management or modeling perspective and an insurance industry perspective versus how that's being described and defined by, we'll call it academia, or by, we'll call it the media. So it's important to differentiate the two. I guess, Kim, do you have anything to add to that? Yeah, they're definitely two different meanings, and I haven't seen there's a lot of cross-communication between, NWS and the insurance industry at all.
I think that catastrophe in the insurance industry is really pertaining to a loss amount, whereas a catastrophe at the National Weather Service might refer to other impacts as well besides just financial. But there's probably crossover.
Yeah, that's a great point, Kim. Yeah, loss versus other impacts. Yep, that's a big one.
Great. Okay, next question. How much will the increasing sophistication of the models reduce the role of the risk manager?
I actually think it's trending the opposite way. I think as models get increasingly sophisticated and rely on sophisticated underlying science, I think the role of the risk manager becomes even more important because, as Sherry mentioned, it's not just pushing a button to run the model, it's knowing how to interpret the output and actually use it to make business decisions. So just getting numbers out of a catastrophe model isn't moving you forward in your risk management process. It's using that information intelligently and strategically to kind of move the risk management process forward. So even as we develop these more complex computer models that give us more and more information, I think the human role in it is still extremely important and increasingly important.
Exactly.
Yep, you nailed it. Yep, exactly.
Was the historical data within CAT models collected painstakingly over time? Where is this historical data coming from?
I can take a shot at that too. I can't speak as much to certain perils, but at least with the weather perils, typically the historical data comes from the meteorology community. So this is not something that CAT modeling firms are necessarily collecting themselves. For instance, the hurricane model, like RMS, uses HERDET2, which is a reanalysis data set provided by NOAA. So they're relying on these very accurate state of the science reanalysis data sets as input to the models. I know severe convective storm models. Both the two major modeling firms, AIR and RMS, use reanalysis data. It's two separate reanalysis data sets, but it goes back, I think, 60 or 70 years. The hurricane data goes back to the 1850s, actually. So yes, it was painstakingly gathered, but not necessarily by the cat modeling firms.
Yep. Yeah, exactly.
Okay. Do you think the cat losses for this year have been large enough thus far to encourage greater model adoption, drive increases in premium? So will there be greater model adoption, and will there be increases in premium?
Yeah, I can try to take a shot at this one. So yeah, two-part question. I think, so the latter part, maybe I'll hit that one first in terms of increasing premium. I think that's referring to, will we expect any rate changes? We're currently in what's called a soft market. So for those unfamiliar with that term, it just means the cost of insurance is very low. It's very competitive right now, whether that's insurance companies competing for the policyholder, you and me, or businesses, or the reinsurers competing for an insurance company's business to place reinsurance with them. So every indication that I've seen, even given the active 2017 season we've had, there's simply been so much capital in the market. So there's a lot of investment in the reinsurers. I mean, if you think about the hurricane peril, the last time there was a major U.S. landfalling hurricane prior to this year was Wilma in 2005, I believe. So the reinsurers have been doing pretty well over the last 12 years. And they've been able to maintain pretty significant reserves. And at least here in the U.S., I haven't seen any indication about additional premiums being collected due to the active season. That said, since the Caribbean, in particular, between Irma and Maria, things were so bad for any reinsurers who had significant exposure in those countries, or Puerto Rico, that our territory. I think there's some indication that there could be increases in rate, which would mean the reinsurers demanding more premium from their insureds. But on the whole, I wouldn't expect premiums to rise all that much. And remind me the beginning of that question.
Do you think there'll be greater model adoption? And
model adoption.
The one thing that I'd answer on that is most companies in this industry are either using cat models, or if they're too small and they really don't have the staff to do it, they rely on their broker. But it's the large percent of this industry already has adopted models because they have to do their rating agency reporting and manage their portfolios to this risk. So I don't know that an event like this will add to greater model adoption, because I think we're already there.
Yeah, I'd agree with that. Yep.
Okay. Next question. In the world map of potential hazards, there was heat. What potential damage for insurance industry can be caused by heat?
I can take that. So not only does insurance protect you against your property being damaged, needing repair or replacement, but it also pays out in the event of your business having to shut down operations, for instance, because of a power outage. So in cases of excessive heat, it can lead to a power outage, which would cause business interruption losses or what's known as additional living expenses. So if you have to leave your home and stay in a hotel, for instance, because your power went out for an extended period of time, that would be an insurance loss. So typically that would probably be your primary mode of impact when it comes to heat.
And heat may also impact, too, if you think about any agricultural insurance products, especially in Europe, and I know in Canada, where agriculture is a big part of that country's GDP, there are actually requirements in place to have insurance on those crops. So if you have excessive heat, you could see major losses in yield. So again, that could be seen either as a property loss where the property is the crop itself. But Kim, yeah, that's a good point too in terms of business interruption, maybe due to power outage, food spoilage. Any of those things could be attributed to a major heat event.
Is any company using open source models, for example, HasUS? Is it worse because it's open source? And what is the difference between this one and the rest of the models like RMS and AAR, which costs a lot of money?
I can quickly answer my experience with this. I don't specifically know anyone that's using HAZIS, but I know I've looked at it before. But I don't know if anyone's using it specifically to generate loss estimates. I do know there are modeling firms out there that are going open source because, as Sherry mentioned, the black box thing is not working anymore in our industry. People want to know what's going into these models and be able to interpret what's coming out of it. So I do know we're moving more towards open source, but I don't really know the answer to your question on that one, if anyone's using some of those more affordable options to do pricing or anything like that.
Yeah, I'd say, one of the bigger challenges with using something like HAZIS, while it's free to be used, again, if you're talking about potentially millions and millions of policies that you're trying to run through a model, it's the IT sort of framework that you need to support that. And it's also the support, and Mark will talk about this in the next part of the series, the whole idea of, okay, well, once you generate a loss at the location, how does that roll down through the actual policy terms? So it's the whole financial module of the CAT models that honestly is a lot of the bread and butter too, just as much as it is actually modeling the actual peril, is how do those losses flow through that, because these insurance contracts as well as reinsurance contracts can be extremely complex. And so to ask an open source model like HAZIS, who may not have, they might have, let's say, the physical sort of hazard modeling component down, I would find it hard to believe they completely understand the reinsurance or insurance business enough to effectively model how those losses flow through those different structures. That's what I would add.
Okay. Next question, and looks like we still have about 10 more minutes. Are there any well-known internship programs in the reinsurance industry that are available for undergraduate students? I can answer one, and I hope you guys can answer afterwards. I do know at Munich Re, we do post intern positions, and we look for students from the risk management community. They get posted sometime early in the year, so around February, March, on the Munich Re America website. You can always go there, and you can apply for internships through there. And they do have a formal internship program that takes place in the summer months with a number of activities besides just working in a department. But there's job postings for different roles in different departments. And it's all whether that department feels that they can use a summer intern, of whether there's any availability. So we do have a formal program, but you need to actually look at the website and see what job postings are available. We also have what's called a risk analyst training program with, once you graduate from a risk management program, you can apply to be part of that program, and you go through basically it's a 2-year training program within the company, but you're an employee. And those positions get filled from a number of people who have been in our internship program. So when those jobs get posted, if there are ones that are specific interns to eventually maybe get considered for the risk analyst program, if you're interested in that, then that's what I would focus on. And I'll let you guys answer for what you know.
Yeah, I would say, at JLT, I know our brokerage team, so being a reinsurance intermediary, a big part of our business are our brokers. And so I know we have an internship program that's typically slotted for, I guess, those sort of in the risk management and insurance field, and in terms of what you're studying, the degree program. So I know we open up those positions a lot to those in the greater Philly area, since that's where one of our biggest offices is in the U.S. For that person who asked the question about well-known internship programs, I'd recommend, you'll have my contact information and Kim's, and we'll get Sherry's as well. We recommend, and I guess I've found the best way to learn about where you can find these kinds of opportunities is to connect with people. So I'd encourage you to not necessarily go through the black box that is the submit resume here on a website, but to connect with people in the industry and to keep doing what you're doing and attending things like this so that you can network yourself effectively, even as an undergraduate student. I think that's a better mechanism sometimes than trying to go it sort of blindly and putting your resume somewhere. Not a great answer, I realize, but for the reality.
And also, Brian and I have both served on the AMS board for private sector meteorologists, and through that is a mentorship program. So if you are an undergraduate meteorology student or graduate student, there's opportunities to connect with mentors through the AMS, and that's a great way to connect with people in the industry and to learn about internship opportunities as well. And then also the CAT modeling firms. So I used to work at RMS, so I can speak more to that, but RMS has a lot of internship opportunities and opportunities for people new to the industry as well. So you can check out those options on their various websites as well.
Good. And similarly, a question, what is the best background for starting to work as a catastrophe modeler? To study geography, GRS, any financial business, or anything else? In my experience, I think, our catastrophe models, we actually, I'd say, complement each other because we come from a range of backgrounds. So yes, I think studying geography, having a geoscience or technical science background is a great in. Another is actuaries. Anyone who is really coming from the math side who were thinking about going the actuarial route but decided they don't really want to do all the exams and go to be a full actuary, but they have that skill set. They make excellent CAT modelers. So those are sort of two areas of study, as well as just regular risk management as well. So I think having all different types of background really help make a CAT modeling team effective. You don't want a CAT modeling team all from the same backgrounds. We need that diversity, but those are a few of the areas that really work well.
And I will also add that a basic understanding of GIS or computer modeling is also helpful. Basic analytics is helpful.
Oh, I agree. It's computer skills. Okay. Do you see it says bespoke and/or location level modeling gaining wider use throughout the industry? I don't know if I misunderstood or that's a typo.
No, I see what that person's asking. Yeah, Kim, do you want to take this one? I've got a thought then too.
Go ahead.
Yeah, I would just say I know the model vendors, and I haven't seen, I guess the only one that I've seen specifically is RMS has we'll call it bespoke location level modeling application. So in addition to the portfolio modeling, you can also do like really customized, I guess it incorporates more granular fluid dynamic models for wind, let's say, to try to generate a more and more accurate loss, especially if you have a very unique structure. So the question being, do you see that gaining wider use? I guess I haven't seen it gaining wider use in the industry. I think it's still relatively new. I think those types of models, not for the purpose of generating a loss, but understanding the vulnerability, is probably more common. We'll call it like in the civil engineering and in the construction business is where those are being used. Now, how that flows into, we'll call it the catastrophe modeling world, where you're modeling for loss and you're trying to better underwrite locations, I haven't necessarily see that get wider use, but it's interesting to see what the modeling firms are coming out with. And I could see going forward as the IT gets better to support that type of granular modeling, it wouldn't surprise me if in 20, 30 years, it's all like location level, like bespoke modeling. Like for every single risk, you're doing like this really custom modeling. But for now, yeah, it's sort of this portfolio level modeling that's being done. Hopefully I answered that question.
Yes, and obviously I'm not up on my British English terminology, as they say this.
So bespoke, yeah.
Yeah.
I will also just quickly add to that in terms of bespoke solutions. I think that companies are taking it upon themselves to build their own models when it comes to perils that are not modeled by the big modeling firms, or if they have very unique risks, maybe there's different emerging risks like cyber or shipping or supply chain, things like that. I think that there are more bespoke solutions in the marketplace that are being developed because the need is there. But the big modeling firms haven't quite caught up to those small specific needs yet. So I would say that those are gaining speed in the marketplace as more and more of these solutions for specific market needs are emerging. Yep.
Great. And we have 2 more questions and 4 minutes. Can different perils be grouped into broad categories, or do they all have completely different characteristics? Is there anything in common between wildfire, flood, storm surge, hurricane, earthquake, etc., either in terms of methods used to create them or the way they are used?
I mean, that's a pretty big question. I can answer to a certain degree. These models are built in the same way for each peril, meaning that there's a hazard component to the model, and that's obviously going to be very different for each of these perils. That's basically generating a footprint, whether that's shaking or wind or water depth or fire, things like that. And then there's a vulnerability portion of the model that translates that hazard into an actual estimation of how much of the building is damaged. And that's also going to be very specific to the peril. Wind damages things differently than water does, for instance. So that's going to be a very different model. The financial components of the model can be similar. I mean, each different peril has different implications when it comes to insurance and how it's applied. But in general, the financial model will be similar across perils. Now, for instance, damage curves that are developed for hurricane winds can be leveraged for use in, say, a tornado wind model or a straight line wind model. So there is some crossover between perils, but for the most part, they're fairly separate development processes. Again, there's a little crossover between, say, for instance, storm surge and flood modeling, but there are quite a lot of distinctions that make developing them separately necessary.
Now, I would only add, in terms of grouping them and for the purposes of modeling, it's a good question, and it's one I've thought about too, where, yeah, if you already, let's say, had an area that was flooded because of event A, and then a week later the ground's still saturated, you still have flooding on the ground, and a hurricane comes through and puts storm surge over that or whatever, so you have sort of this multi-peril correlation. What does that mean for the final loss? I mean, the models, yeah, they're really, in terms of by peril, for the most part, are built in isolation. For the severe convective storm model or severe thunderstorm model, there is a grouping of the 3 perils that make that up: straight line wind, tornado, and hail. So that specific model is trying to capture sort of this multi-peril correlation between the 3, how they're all generating loss in a single event. But sort of the more broad perils that are being modeled, the modeling companies, that's a tough problem. And I think ultimately it comes down to just having good data about that too. So,
a good point, Brian. I like your answer.
What do you guys think is the weakest part of CAT modeling these days? I would say sometimes not having enough claims to really check the results of the models against, which is a good thing because we don't want these events to happen. But without these events, it's definitely hard for us to actually continue to improve the models. It's hard to calibrate the models without actual claims data. And even sometimes we have claims data, sometimes there's just not enough of it, or it's not able to really be separated out the way it's needed to truly calibrate some of the components of the models. So I think that's one of the weaknesses. I don't know if it's the weakest part.
I'll also say from my perspective, I think the challenges of building these CAT models to capture what a future might look like in an environment that is changing is going to be a huge challenge for CAT modeling firms. And I think that it's already a bit of a weakness, and the modeling firms struggle with how to capture a generally warming climate within the framework of this historical data that they used to build the models with. So I think that that's certainly going to be a challenge as CAT modeling evolves.
I think one more question came in, and this will have to be the last one because we're actually out of time. How are dynamic socioeconomic factors being applied in CAT models?
I guess they really aren't. You know, how with the sort of socioeconomic impact, I guess unless it's creating some element of loss. I would say the closest thing I can think of that the models are including would be sort of the business interruption loss or the concept of demand surge.
Yeah.
So in the case of event, then when you have basically a lot of demand for rebuilding or demand on adjusters for adjusting claims, which I would say is a bit more of a socioeconomic factor, they are trying to account for that in terms of the end loss. I guess it's important to remember that catastrophe models, the end goal here is to provide insurance companies or reinsurers, provide them some insight into what their loss is going to be, which their loss is going to be very different than, we'll call it, the broader economic loss. And so, the models, for all intents and purposes, they don't really care, about, let's say, the socioeconomic factors as much, unless they have a direct impact on what the insured or the insurer or the reinsurer will see in terms of loss. And if I'm wrong, guys, correct me, but that's my perspective at least.
No, the one thing I'm going to add, and I don't know what will happen after this hurricane season, but back in 2004, 2005, when there were so many hurricanes, we knew that the economic demand surge would be higher than normal and higher than what was originally considered in the model. So some of the modeling companies actually adjusted their model the following year to increase some of those numbers. There was an additional BI impact, and they increased that in the model temporarily. They had some temporarily factors built in, and then each year they reduced that until that temporary addition was taken out completely. So there have been times where they considered it when it was significant, and we don't know what the modeling companies will consider going forward in their next versions due to any of the events from this year.